We all have this picture in our heads of the perfect investor, right? Cool, calculated, always making the right call. But then there's reality. There's us. We see a stock blowing up online, we get all antsy when the market dips, we just kind of follow the crowd. So what gives? Why is there such a huge gap between how we think we should invest and how we actually do? All right, let's get into it.
So first things first, we've got to talk about this idea of the perfect investor. Because, let's be real, according to decades of research, it's a total myth. Classical economic theories were built around this image of a perfectly rational person, but they forgot about the single messiest variable of all, us, human psychology.
So on one hand, you've got the textbook rational investor. Think of them like a supercomputer, just logically crunching all the data to get the best returns. But on the other side, well, that's the investor you see in the mirror, the real-world investor. And as piles and piles of research confirm, we are constantly getting pushed around by fear, greed, and hype, which leads to what experts politely call irrational behavior.
So where does this huge disconnect between the ideal and the real actually come from? Well, it's not about being bad at math. It's about how our brains are fundamentally wired. And you know what? There's an entire field of study dedicated to exactly that.
It's a field called behavioral finance, and its whole mission is to look past those old, stuffy, rational models and understand what's really going on in our heads. It explores how our very human psychology, our quirks, our mental shortcuts, our emotions, directly shapes our financial choices and, honestly, the entire market.
Now this quote right here from Nobel laureate Daniel Kahneman, it's absolutely key. He points out that our brains are hardwired to use these little mental shortcuts, these rules of thumb, to make decisions on the fly. And that's an amazing survival skill, if, say, a tiger is chasing you. But when you apply those same shortcuts to investing, they can be, well, disastrous.
To see just how disastrous, we're going to dive into a fascinating study that looked into these exact mental shortcuts. It examined a group of real-world investors to find out what's truly pulling the strings on their decisions.
So the researchers went out and surveyed 520 everyday retail mutual fund investors in Karnataka, India. They used a really detailed questionnaire designed to measure precisely how much a set of common psychological biases were influencing their choices. So this isn't just theory, right? This is data from the real world.
The study zeroes in on 8 key psychological biases. Honestly, the best way to think of them is like hidden culprits, working behind the scenes, secretly pulling the strings on your financial decisions. We don't have time for all 8, so let's just put a spotlight on 3 of the most common ones.
First up, a culprit you have almost certainly run into: herd bias. This is that little voice in your head that says, hey, if everyone is running in one direction, they must be right. When everyone else is piling into a certain stock or crypto coin, our brain tells us to jump in too, often without doing any of our own research.
So be honest with yourself. Have you ever jumped on an investment bandwagon, mostly just because of the hype? Because everyone was talking about it? Yep, that's the herd bias culprit at work.
Okay, let's move to our next culprit. And this one's a tricky one: overconfidence.
Oh yeah, this is the I got this bias. It's the conviction that we are smarter, savvier, or just plain luckier at picking investments than we actually are. It leads us to trade way too often, take on way too much risk, and ignore giant red flags, all because we're sure we know better.
And our third highlighted culprit is called anchoring bias.
This happens when our brain latches on to the very first number it hears, the anchor, and then just refuses to let go. Maybe it's the all-time high price a stock once hit, or the price you first paid for it. We anchor to that initial info and judge everything against it, even when it's totally irrelevant today.
So we have herd bias, overconfidence, anchoring, and 5 other culprits the study looked at. But here's the billion-dollar question. How much do they actually control our financial lives? The researchers crunched the numbers to find a definitive answer to that question. How much of our investment decision-making can be explained by these psychological factors alone? The result is just staggering.
61.67%. Just let that number hang in the air for a second.
That's right. The study found that nearly 2/3 of the variation in our investment decisions can be explained by these psychological biases alone. This isn't just a small influence, this is the main driver.
So, the crucial point is this simple but powerful chain reaction you see here. The cognitive culprits influence your thinking, and that thinking directly shapes your decisions. Psychology isn't a side note to your financial story. It is the main plot.
Okay, so that's the problem.
But here's the great news. The study also points us toward the solution. Once you know the enemy, you can build a toolkit to fight back. And this brilliantly lays out the playbook. The big ideas? Spread your bets through diversification, so no single mistake can wipe you out. Tune out the daily noise and social media hype, and focus on your long-term goals. And maybe the most important tool of all, self-awareness. Just knowing these biases exist is half the battle. And if you need an objective eye, professional advice is always an option.
Look, the goal isn't to become that mythical, perfectly rational investing robot we talked about at the start. That person doesn't exist. The real goal is to be a smarter, more self-aware investor, one who knows the mental traps and how to step around them.
So, we've introduced you to the hidden culprits that are vying for control of your wallet. Now the final question is for you. The next time you're about to make a decision with your money, who's really in charge? You or your biases?